Go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. EOS is dead, long live Volta. Yves LaRose is back on the front lines, this time with a bold plan to turn blockchain into a core layer of global finance. My guest today... Yeah.
Well, nice to be here, Rocco. Yeah, like we were saying, the energy is awesome. All into it. The French Canadian is strong today with us. Yes, it is.
So as we are recording the 25th of April, the headline says the world's largest asset manager, BlackRock, has accumulated 12,500 Bitcoin over the last 3 days, marking a $1.16 billion investment. They are just slowly creeping and buying all the dips. That spot ETF is just... What are your thoughts about what they're doing?
So I've been in this space since 2010. I started mining Bitcoin very early on, part of the cypherpunk movement. I started building computers when I was 6 years old. So when the space first started, there was kind of an anti-establishment feeling for obvious reasons, came out of the 2008 crash and such. But realistically, at the same time, if you've been a builder in this space for a very long time, there is a hope that at some point this reaches mainstream. And there's no way that it reaches mainstream until you have institutional adoption. And that's really what we've seen since last year when the Bitcoin ETFs were approved. And that's really a part of kind of where we see the opportunity and why we've realigned what we've been working on to take advantage of that. Because at the end of the day, if you want this technology to be kind of everywhere, daily lives, you're going to have businesses that are going to be that will be using this. Institutions will be using this. Financial institutions will be using this. So it's inevitable.
Okay. But isn't BlackRock the antithesis of what crypto was supposed to be? And I say supposed to be because we have gone through a pivotal shift, I think.
Yep. Well, there's definitely a change in the capital that's entered the ecosystem. So there's a change in the maturity of the capital and the type of capital. But the underlying tech, though, and I think that this is really what matters, the fundamentals of what drove the industry and how the industry was built still is what you just called kind of the antithesis of the BlackRock. So everything is still very much decentralized, and they have to, when they come in, play by the rules that we've established. And so as much as the assets tend to centralize, and this is an economic rule, this has nothing to do with blockchain per se, BlackRock is now becoming a larger and larger holder. I forget what the percentage of the ETFs they hold, but it's a significant percentage. But overall, in terms of assets, the asset distribution overall of all digital assets is still much more distributed than, let's say, the traditional financial space. It does tend to centralize, and obviously large players have the advantage of being able to play the game at a different level and absorb more and more. But fundamentally, the underlying tech and the principles that led to the creation of the industry, I think, are still very much alive and well.
Okay, but let's give them a few years, and let's say they accumulate enough. There is a real threat that they could manipulate supply. Well, not supply, but the market.
I don't think, so the market is different. So I think that the market
that's why I corrected myself.
Yeah. I would say the market, because if we're talking about the supply side, then maybe we're talking about the issuance or the actual algorithm, Bitcoin algorithm in this instance.
Yes.
I think that that's safe and that's good. In terms of markets, I don't think that you can escape large players being able to, in some ways, shape and or direct the market. So if it wasn't BlackRock, there has been exchanges. There's large whales. This is an economic theory that most people will trade the ups and downs, and those that win in the end are those that have more and they play the long game. So assets inherently centralize into the few. The difference here is that the few are different than the traditional system. So BlackRock is now a large player, but there are also other large players in here, not just them. And so they will get more and more, but they're not alone in it.
Yeah.
And then people like you and me at the very end of this have our choice of being able to kind of go in one route or the other. If you're a miner, you still have decentralized mining pools. You're still able to shift your hash power. If you've got different assets like Volta, for example, that's a completely different segment. So there's still a lot of opportunity that's outside of BlackRock's hands. But you're right that it does tend to centralize in the few. And BlackRock being such a large player, they inevitably have a larger
Yeah.
advantage than you or I, for example.
Yeah, you talked about Volta there, and Volta used to be EOS for those that didn't know. What drove the rebrand for you guys, and what's kind of the larger vision? Is it just a naming change? Is it just image? What is it?
It's a little bit of both. So, I mean, the rebrand for Volta essentially started 3.5, 4 years ago when the foundation was created. At network launch, the foundation did not exist. There was a different entity essentially that ran the ICO and that made commitments, and they were developing the protocol. They left, and when it became apparent that they were gone, the community and the stakeholders, the token holders, the validators essentially got together and leveraged the blockchain itself to install new levels of governance and this centralized entity called the foundation.
Okay.
And rebrand effectively started then. So in August of 2021, when we were founded, we didn't have access to our own IP. We didn't have access to the socials. We didn't have access to the GitHub repo. We didn't own the name EOS or even the logo. So one by one, we had to create everything from scratch. And really, when you look at the branding or the rebrand from a kind of a spectrum perspective, we always thought, at the tail end was doing nothing, status quo. On the other end was name change, ticker change, and we're there in our journey basically. So the network has not been EOS effectively from a brand perspective or a narrative perspective or for years, but everything's really culminated to this. So the main driver behind is a business case. So a lot of the functions, features we've added over the years, who we are as a community, where we're planting our flag in terms of where we're going, all of that really circles around Volta, the name, and that Web3 banking narrative. And that really epitomizes all the work we've done as a community over the last 4 years or so. But a rebrand exercise is very extensive. EOS is listed on over 200 exchanges. So to do something like this is a monumental task, right? It took a very, very long time to finally get here, but step by step, here we are now.
Okay, so you talked about people leaving. What was your, looking back into the EOS days, what was the biggest lessons that you can take from those days going forward?
So, I mean, very different environment here and then. When we're in 2017, 2018, ICO summer, there was the hopes that at that time we had finally gotten an inflection point where mass adoption was here. You know, CryptoKitties had taken down Ethereum. Networks Gen 2 layer 1 blockchains were just not sufficient enough to meet the supply. And I think there was a lot of hope that this was it, that people would now start using this kind of the Facebook, YouTube moment 2005.
Yeah,
but in
it was
2017
more like,
with blockchain.
like this, I think.
Yeah. Well,
crossed.
still a lot is like that, but we
Yeah.
are seeing a shift. And a lot of what we've seen is there was a lot of kind of hand waving and speculation in terms of what could be. And that still remains, that still exists. But I think in terms of lessons learned, what we've seen is those that actually provide fundamental value and that slowly build day in, day out, and they're not necessarily here for the hype cycles, which have come and gone and have disappeared. Those that really have strong fundamentals and keep working constantly in the end essentially get rewarded. So we've had quite a tumultuous history. We've moved up and down in ranks, price wise, etc. But we've always stayed pretty strong in terms of fundamentals, and that's clearly paying off.
Okay, so you talked about Web3 banking, and I read somewhere you called Volta the banking OS for the Web3 world. What does that actually mean in practice?
So right now, you and I, if we go to the bank, most likely because we're small people, and I don't mean that in a derogatory way.
No,
just individuals,
right.
If we go to the bank, we have access to maybe checking account, savings account. Maybe we can get a credit card, get a mortgage. Maybe we buy into mutual funds, that kind of thing. But if you're an institution or if you're a private banking client, you have access to products and services that are only accessible to you in large part because there's a large buy-in. If you look at even savings, for example, you get access to lower MERs or you get access to certain products if you have, $500,000 with the bank or $1 million or $5 million, whatever it may be.
Collateral, whatever, yeah.
Yeah, those products exist, but they don't exist to you or I simply because the administrative overhead of running them require more capital to kick it off, to start it.
Makes
And
sense.
so what we're trying to do with the Web3 banking OS narrative is democratize access to those financial services down to the retail users. In large part because blockchain inherently brings about the capability of reducing those administrative burdens and those administrative costs and really like opens up the access because a lot of that's just abstracted away in smart contracts. And so the cost of doing business, and we can get into specific details,
Yeah,
but there are
please
certain
do.
products that are just not accessible unless you have so much. Let me give you an example.
Yeah, sure.
Right now, we have a pilot project and we've partnered with Cefu, Cefu as a custodian, to be able to custody some assets. And then Cefu has the solution through Binance that's a Mirror X solution where your assets are with Cefu. Cefu was born out of Binance. And those assets are locked into Cefu, but they're on chain, on Volta. But then the assets are mirrored onto Binance, and you're able to trade your assets on Binance, but your assets are not actually on Binance. So your assets are safe. They're on chain. You're able to benefit from, let's say, on chain stake protocol yield, etc., direct protocol yield, while also at the same time benefiting from running quant strategies running on a centralized exchange. Now, for you and I to be able to, have access to Cefu is not possible because we're retail users, we're not an institution. Two, to afford a quant team to be able to run, in this example, let's say delta neutral trading strategies, not accessible unless you have a certain amount of capital because they cost money, whether they take carry or whatever, there needs to be a certain amount of capital for them to make it worthwhile.
I feel you.
With our CVDeFi product that we're building right now, we'd be able to open that up so that a user that maybe only has $1,000 worth of assets, $100 worth of assets, can still benefit from that product that traditionally would only be available to institutions or large banking clients. So that's the kind of thing that we're talking about in terms of democratizing access to financial services.
Very interesting. You talked about legacy banks. Okay, well, all banks are legacy. And you talked about partnering. Are you partnering with them, or is it a completely different sort of system? Because if you're partnering with them, what is the likely buy-in from their side going to be?
Good question. So there's two separate components there. One of them is partnering with traditional banks to offer services or integrate blockchain into services they offer. Let me give you an example. Right now, if you go to the bank and you want to get a mortgage for your home, you can collateralize assets.
Yeah.
The bank right now today would not collateralize any digital assets that you have. They will not count those as assets towards being able to give you out a loan. Right? So if you have stocks, commodities,
even though Bitcoin
they will
hit
not
95,
collateralize your Bitcoin.
Yeah, even though it hit 95,000 again.
Doesn't matter. So let's say you're sitting on $1 million worth of Bitcoin. The bank will look at you, but in your bank account and in stocks and whatever assets you have, you don't have that. Sorry, you are worth zero on paper, even though you might be holding a lot of Bitcoin. One of the things that we're working on is with financial institutions to be able to move the needle forward so that you can, at a base, collateralize digital assets. So that's one. Another thing would be an announcement that we made a few weeks ago. We partnered with the Virgo group to, and they'll be deploying something called Virgo Pay. We've got a lot of foreign workers that work all around the world. Obviously, they move to a country and they repatriate funds back to their home country.
Yes.
They do this traditionally in very vanilla traditional solutions like Money Union, TransUnion, MoneyGram.
High fees.
High fees. So either it's a set fee, so it makes no sense if you're sending low amounts, or it's a percentage of fee, which makes no sense if you're sending large amounts. Stable coins are made for that. Stable coins are global, they're transparent, they're incredibly fast and cheap. And so we partnered with the Virgo group to launch Virgo Pay, which will be settling on Volta, focused on 6 jurisdictions at launch, but really in that remittance area where local fiat on-ramps and off-ramps partner. The settlement layer is the blockchain itself. And now you're able to send capital across jurisdictions incredibly quickly, very low fees, all while integrating traditional financial rails on both ends. So that's an example of the kind of thing that we've done and that we're continuing to work towards.
Okay, working towards. So obviously, you need to bridge the gap between crypto and traditional finance. You talked about some things that you are doing, you're engaging, but how, in your mind, do you need to make it attractive for them to say, listen, because ultimately, this is how I see it. When they are making less money, that's not good business for banks. Banks want to make more money. So how do you bridge that? How do you bridge that gap?
So a very good question. We're not looking at, and if you go back, I said I've been here since 2010. Part of the ethos back then was to revolutionize the system. The system is all garbage and all of it is bad and thousands of years of evolution, complete garbage. Let's change everything. The reality is that's not the case. No. The system is efficient, but it can be made more efficient. And so what we're looking at doing is an evolution to the system, not necessarily a revolution, whereby if you're a bank, you want to have access to more capital, more assets, because you can make money off of those assets. So integrating into Web3 technologies allows you for more customers, more assets that might not be captured on your books right now. And then a part of how they make more money as well is the cost of operating are lowered with blockchain inherently, because that security function is inherent to the blockchain itself. So right now, one of the largest costs for businesses all around are ransomware and hacks and et cetera. Because the way that the internet was built, that security protocol layer is not within the protocol itself, it's above it. Well, with blockchain, it's inherent too. And so you reduced overall costs to operate business. You remove a lot of middlemen. Now, so of course, those middlemen now are the ones getting displaced, but they're able to then also provide their services leveraging Web3 technologies. And ultimately, everybody can make a little bit more because the costs are lower. There's just less inherent cost to operate. But we do see this as an opportunity for them, because a lot of...
what's the average cost deduction, thumbs up, if you would guess, in percentage?
To what?
What is the average cost reduction that blockchain can bring? Is it tough? Is it a tough question? Would it depend?
It's a good question. If we looked at remittance, I know that if you're sending a remittance across seas, let's say somebody that's in Canada sending back to the Philippines, we have a lot of foreign workers from the Philippines. From what I know, it might be a $50 transaction every time around. But that $50 is not going necessarily just to the company, is going to a bunch of people in between. That user is now paying that, right? Whereas it costs to move a stable coin around on the Volta network right now, depending on which one, if it's USDC or USDC, we're talking about sub penny. So it's insignificant. So that's a cost saving to the user, but it's also a cost saving to the person on the other end. So if you've got your remittance payments provider on the other end, they're charging you that fee. They're not necessarily making that fee. They have to charge it because they're being charged. So they can also charge you less. You can keep more, and everybody ends up winning in this equation. Jesus, some of it is simply because our systems are in a way antiquated, and we're part of what blockchain does is it creates efficiencies.
Yeah, cool. So what's the plan for Volta in the next 12 months? What's some of the things that you want to accomplish?
So we've got our 4 pillars that we're focused on. So the wealth management, consumer payments, tokenization of assets, and insurance. One of the big things that we'll be releasing and announcing in the next month or so is the insurance side of things. And why insurance is important is, in this space, there's kind of a cat and game mouse that's been played over the years, where you can't have access to financial services unless you're insured. And I'm talking about real world insurance, directors and officers insurance, cyber attack liability insurance. And those insurance companies either refuse to provide insurance to blockchain companies because they just don't understand the risk, and so inherently it's a higher risk, or because they don't understand the risk and it is inevitably then unknown, therefore higher risk, they charge incredible premiums. And that stifles innovation. So one of the things we've done is we've partnered and we've invested. We're a major stakeholder in what's called Blockchain Insurance Inc., which will be the world's first digital assets captive insurance. That'll bring down the premiums for companies to be able to be insured, so that then that meets that checkbox so they can get financial services, which will drive more people to be able to deploy capital in this space, build in this space, and essentially create more innovation in this space. So that's one of the things that we're working on that we'll be announcing, and that should go live in the next give or take 6 weeks. Another thing that we're looking at seeing is consumer payments. So I talked about the Virgo Pay earlier. Another thing we're working on is being able to offer think of a credit card, so Visa, MasterCard type of thing, where it would be loaded with stablecoin, so that you could go to your local restaurant, grocery store, whatever it may be, pay in in your regular whatever
currency
payment, but then you can reload it using the chain in the background. Now what's interesting with this is it would fit in our wealth management pillar, whereby you would have assets that you would stake, you would earn protocol level yield, going back to what I said earlier with maybe mirroring assets, having delta neutral quant strategies, or whatever your risk profile is, earning yield. That future yield is what you could take a loan on to reload that credit card. Because you're taking out a loan and it's debt, that's not a taxable event. And then you could repay your credit card with future yield by collateralizing assets. And so we're creating a product around that. We're hoping that that'll launch by the end of the year. But that's the kind of thing that we're working on.
Awesome. Sounds awesome. Yves, thank you so much for joining me today. If the listeners want to go and connect with you, find out more about Volta, where can they connect with you guys?
So on X, at Volta _. On Telegram, we got our Volta official channel. And if you want to connect with me, at Big Beard Samurai. Our website, volta.com, you can get all the information there. And if you already own Volta tokens, then the official portal is unicove.com.
And we will put all the links in the comments. Thank you so much for joining me today. And to our listeners, peace, love, and prosperity. We'll catch you in the next one. Cheers.
Where do we go when we need to escape? Who do you call when you're losing your faith? Who do you trust when your heart is betrayed? Don't you worry. Where do we go when we lose all control? What do we do when we start to lose hope? When do we learn when to let it all go? Don't you worry. It feels so good to feel so good. 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 Where do we fly when we're finally free? Who do we love when we love endlessly? Why would you hide when you're meant to be seen? Don't you worry. It feels so good to feel so good. It feels so good to feel so good. It feels so good, 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 good.